Hi, everyone. It's PJ Patterson here from Market Update. Today is Tuesday, December the 8th. Top three things today. I'm going to try to get through this really super quick for you so you don't have to listen to me ramble on too much. Top three things today. As usual, the U.S. dollar. I'm going to hit on that. You get the U.S. dollar right. You get a lot of stuff right in global macro, which has been really working well for us. Number two is going to be inflation. And number three is going to be the continued Quad 2 setup and what's going on in the Quad 2 portfolios, which we have on at the moment, Quad 2, that is. So first and foremost, the U.S. dollar. So just jumping back to this chart table, rather, that I continually show you guys on the U.S. dollar. Inverse correlations, these things matter. And what we're seeing is that over the 15-day and 30-day period, which is an important time frame because this is the time frame that the machine follows. So many investment houses now do a lot of quantitative or quant sort of trading. They have super high-powered computers, or supercomputers, I should have said, programmed with algorithms and learning and all of these really fancy things. And what they do is a lot of high frequency trading. But one of the correlations they look at are the shorter term correlations of key assets classes or currencies, even like the US dollar. And that's why I keep bringing this up to you and pointing it out. It's a very important thing to know, and a correlation that we have to, as global macro investors, pay attention to. Because when these things change, or if they begin to shift, we should obviously see things begin to shift or change in the market. So just to highlight this again for you, the correlations, particularly for some of the key asset classes that we follow, like the S&P 500 or markets or indexes for that matter, very high negative correlation, which means, again, as the US dollar rises, these things will fall. As the US dollar falls, these things will rise. And one of the things you'll probably notice there now is over a 30-day period, the inverse positive correlation that we have between gold and the dollar. Now, again, I would have said over the last couple of updates that we're out of gold. Gold is not an asset class that you want to own in Quad 2. So I was liquidating gold, getting out of gold positions probably a month ago, trading in and around those a smidge, but definitely out of gold about a month ago. The other thing you don't really want to be in as far as that is concerned is interest rate securities. So again, got out of all that stuff. And now we've got really, I suppose, the inflation trade on, which is item number two. So I'm just going to jump back up to a few other charts here. And first of all, just talking about quickly, I'll touch on this, the 10-year yield, because this is where we're going to start to see, or we have already begun to see, the shift in the mindset of the market around inflation. The 10-year, and for that matter, the 2-year yield, but all across the curve in the U.S., because now there is we're beginning to see inflation expectations creep into the market. Now, here's the thing: inflation has already smacked the person on Main Street in the face. We've seen oil prices rising, all commodity prices, copper, lumber, soybeans, wheat, corn, cocoa, all of these things. In particular, that I mentioned oil, energy, all of these things, the prices of these things are rising. And that's what affects the Main Street, if you will, the people on Main Street. It doesn't affect the wealthy because they can absorb that stuff. But the US dollar is falling now. It's in a bear market. It will continue to be in a bear market probably through the first 6 months of next year. That's going to mean inflation, and that's going to translate into this chart, which is real rates rising. We're going to continue to see the U.S. Treasuries rising. We don't quite have the same dynamic in Australia, of course, because the Australian dollar is going to rise as the U.S. dollar falls. So we will naturally in Australia see our purchasing power will stabilize or increase relative to the purchasing power of the U.S. citizen. And in the U.S. dollar, if you're paid in U.S. dollars, their purchasing power will be falling, whereas our purchasing power in Australia will be rising. So that'll mean, for example, as the Australian dollar rises, it'll be cheaper for you to buy stuff from overseas on Amazon or whatever and have it shipped out here, probably cheaper than to even go down the street and buy the same thing from the local shop, because most of it they import anyway, and they would be selling it, at a price that's probably higher than what you could get it if you, again, just bought it from overseas. But anyway, I think you hopefully get the point of what I'm trying to make there, which is that we will absorb some of the inflation through the increasing value of our currency. So it won't necessarily hit us as hard. What we'll have is potentially domestic inflation, because we will, of course, be seeing, and we'll see this in asset prices like housing, because the Federal Reserve here, or the Reserve Bank, I should say, is, of course, got a very easy monetary policy setting, and our government is stimulating the economy. So we will still see a little bit of inflation here, but it'll be sort of homegrown, if that makes any sense. We won't be importing that from the US or anywhere else in the world, because our currency will be appreciating. That'll be an offset for us importing inflation. But of course, we can still have scarcity of goods and services here in Australia, or whatever, a high demand and low supply of stuff, which will mean that prices will rise here in Australia. So interestingly, and just interestingly enough, the oil price has risen probably a good 25% in the last month and a half, probably more. But we haven't really seen that translate into the pump here in Australia. The petrol prices haven't risen. And of course, that is because the Australian dollar has risen as well. So it was trading, let's say 2-3 months ago, it was around 64 to 67, something like that, cents on the dollar. And now we're sitting in that 72 to probably 75 cents on the dollar, and probably headed higher as well. I have no prediction on where the Aussie dollar is going to go. Don't really care. What I do know right now is the Aussie dollar is in a bull market, because the US dollar is in a bear market. So at least for the next 6 months, we should continue to see the Aussie dollar appreciate. And that, ladies and gentlemen, is really inflation. You can see that showing up as well in the price of other things. I don't think I've got charts there. Let me just check and see. There's your US dollar index as an example. This thing has fallen off a cliff. So back in June is where it peaked, around 100, a little over 100, and it's just been nothing but just falling off the table, literally. And this chart, as you can see, is going to have to be resized so that it will capture where the US dollar is headed. Now, I think back in the last crisis, or not crisis, but the last part of the cycle where the US dollar went down, and the dollar index went down to somewhere in the 70s. So what that means is that we've got a long way to go to the bottom here, or before we bottom. And that will likely occur, by the way, in the back half or even the fourth quarter of 2021. I don't want to get ahead of ourselves here, but certainly that's where things start to look a little bit dicier for the recovery and the economy and so forth. So anyway, again, don't want to get ahead of ourselves. Let's just keep our eyes on our fries for the next couple of quarters, which are definitely quad 2 quarters. Anyway, inflation, you can see it in copper, boom, up and to the left, inflation there. What else do we have? Crude oil starting to break out. It already did sort of begin that breakout back in June, July. Went sideways for a while, but it's definitely moved higher, no doubt about that. And I think that was it as far as the inflation sort of charts that I had there. Yep, and I am going to touch on, now, let's move on to the quad 2 setup. So item number 3 today is the quad 2 setup. What we're seeing is in places like, if you look at this chart here of Thailand, this country has just gone absolutely bonkers. And you can see similar charts. I have one here of the Kospi in the last, I'll just go year to date, might be easier. But again, we're seeing this. It's probably not quite to scale it like this one is, but we're seeing that up and to the left. I mean, here you go. November bottom on Thailand, bang, up and to the right, just gone parabolic. This is Korea. Again, here we are, November. Funny that, right? The US dollar starts to crack it around that time. And here we go, emerging markets going up and to the right. You could say similarly with China. I'll just give you a quick chart of the Shanghai just so you can get a feel for that. We'll go year to date. And I bet you, funnily enough, around November, there you go, it started to take off again. So again, we see China, we see the emerging markets, and I could put a chart of the Philippines, I could put a chart of where else? Actually, let's put a chart of Australia up there and have a look at that. So there you go, November, right around that November time frame, bingo, bango, bongo, 6,000 to 6,600, a 600%. That's a 10% gain in about a month and a half. It's just been phenomenal. So anyway, this is the quad 2 portfolio. So all the countries around the world that have a lot of natural resources, Australia is one of those, that are seeing their currencies gain in purchasing power as the U.S. dollar falls. Their economies are starting to fire. Those are the places that we want to be invested. And guess what? You're invested in those places, which I'm very, very pleased to say. And you have been for probably better part of a month now. So all of November has been a very good month for all of us. I think all accounts were up in the aggregate around, so far at least, around 6%. This is for the year, of course, but a lot of that gain has occurred just in November. And I'm very excited as we move into next year to continue to see this run, or to continue the run that we have had. And again, this is going to bear out in things like oil, energy. I'm just going to see if I can pop some energy stuff up there. So oil, looking at the oil price, again, I'll just go to year to date. And this contract, this is not quite what I was looking for, but in any case, you can see here that oil has begun to move up. This is a continuous contract chart, so it's not exactly what I wanted. So let me just see if I can actually, whoops. Anyway, sorry, I'm just vamping at the moment. What else did I want to show you there? Now, commensurately, Europe has been a basket case. So don't own any European stuff at this point, because a lot of economies there in Europe are in Quad 4. If you look at Germany, to be exact, they're in Quad 4. They're having a real tough time of it at the moment. They had a bit of a crash through November. They've obviously recovered, but they're going through a resurgence of COVID over there, as is the U.S. So this is going to bear some watching over the next couple of weeks to see what the vaccine news actually does in the U.S. Now, just on that score, we've got, actually, let me just go back to the front page here. So we've got, I think the story may have faded off the page. Anyway, we have two, I think it's Pfizer, and there's one other company that is hoping to have their vaccine fast-tracked and rolled out in the next, let's say in the next month. This is going to light a fire under the markets because they're all going to get very positive about that. But here's what's really going to light a fire under the markets. It's all the stimulus. So you may recall I've been talking about this. The Biden administration is, as soon as they take over and they kind of settle in January, they're going to unveil some form of massive stimulus package. I suspect it'll be somewhere between $700 billion and probably they'll try to use the T word, they'll probably try to get to $1 trillion. So in any case, that is really what's going to light a fire under the markets. And again, it's also going to, markets are going to start anticipating things like the rising of yields because inflation, all this monetary stimulus and printing and so forth is going to cause inflation. Now, some of you know, many of you know, and I've talked about this before, that I'm a bit of a gold guy. And I'm less of a gold guy these days because, of course, I'm going to be a full cycle macro investor. And if gold doesn't work in Quad 2, then I don't want to own it. And guess what? It doesn't work in Quad 2. And as I've been explaining, and I won't go back over it, you can see from the correlations and some other things that it isn't working. And so it's not something I want to own. But here's the kicker. Again, towards the middle to back half of 2021, we will be looking to reposition portfolios. So I dare say there's going to be there's going to be a lot of money to be made just on the inflation trade. And that's going to be fantastic for all of our portfolios because we own energy, we own things that are going to be going up at a rate of knots because of that. So other things, and again, I haven't had time this week. I've been trying to sort of wrap up things so I can kind of cruise into the middle of December and then to the holidays. But I will be doing a monthly update, perhaps later this week, where I go through positions and some more detailed analysis on exactly what's going on there. But just to touch on a couple of other final things that I typically touch on, the volatility of the market has come right back. This is a massive green light for being fully invested, which we are. Things like the VIX has come down well below 25. The Vixen's below 30. That's a tick. Even the Aussie index, the VIX in Aussie, the volatility in Australia, has come down below 15. That is a massive sign that all is well and that this market here in Australia is going to continue to power ahead. Russell and a few other things have come down. Oil volatility has come down. volatility is just coming out of markets right at the moment, and that's a very, very good sign for what is coming down the pike. Now, again, because I talk a lot about volatility, and you know that that's one of the key things that you have to watch. If we see some spike in volatility that's sustained, so volatility is episodic, typically episodic and non-trending. So at the moment it's non. Let me rephrase that. Volatility spikes typically are episodic. So you see a big spike of volatility. I've shown you charts where you see this rampant volatility and then it comes right back down. So it's episodic, and it's usually around some sort of market event. And hopefully we've seen that volatility now out of being wrung out of the markets. And I'm sure, however, that it'll still exist in some asset classes. But anyway. The point about volatility that I'm making really is that it is now at levels that are absolutely safe, and we can certainly have all of our money invested, which we do. Currency-wise, here you go. Again, you can see sort of back in that November timeframe, that's when the Aussie took off. You could probably say that about a few other currencies. So again, I would expect that the Aussie will continue to just keep trending higher. And that is probably really at the moment about all I want to talk about until I get to individual positions. So, ladies and gentlemen, thank you for your attention on this update. Hopefully it's been useful. And again, I will be coming out shortly with more in-depth stuff on our positions. Have a great day. Talk to you soon.